Hey guys, Andrew Malcolm here, Mortgage HQ. Today we're going to talk about two things, borrowing power and how long you should refix. So with the changing interest rates, they're going up quickly, a lot quicker than they have in the past. What's happening at the moment is banks are actually pricing quite differently, and what you might see is even 1% difference between banks. That's the first thing. The second thing is test rates have been changing quickly as well. So some banks have test rates where they're stress testing even 1.5% higher than other banks. That's the second thing. The third thing is debt to income ratios. Banks are looking at capping borrowing power based on how much money you earn, and they're doing it in different ways. That's the third thing. The fourth thing is just other random variables that banks calculate borrowing power based on that's different from each other. So what does all this mean? It means borrowing power across the different banks at the moment is vastly different between the banks. So what you got to do if you're looking at getting your first home or getting a second property for investment, borrow money in any way, don't just go to one bank and ask them what's your borrowing power. Jump on the borrowing power calculators at all the banks, enter your details, get a high level indication of how much you can borrow from each of the different banks, and I bet you it's very different numbers. Now one bank might be saying 500,000, another bank 600, another bank 700, even another bank 800,000. There's like a big difference in borrowing power at the moment with all the variables in play between the different banks, and your safest bet to make sure that you actually can maximize your borrowing power, if that's where you want to go, is to work with a mortgage advisor that's accredited with all of the banks. And when they're doing their calculations, they're assessing based on your number of dependents, number of cars, income type, age, all of the variables that the banks look at. What you want is a mortgage advisor that's going to tell you, hey, this bank is going to lend you the most and these are the reasons why. And you especially want to get in early in case you need to switch to that bank 3 to 6 months before you intend on borrowing the money. The second thing is, because interest rates are changing so quickly, there's kind of a panic in the market for mortgage holders and potential borrowers at the moment that interest rates are going to skyrocket up and that people should be looking to fix for longer terms. Now what this does is people start looking at 3, 4, 5 year rates and locking in their repayments at 1, even 2% higher than is available for their 1 year term. So you might be able to get, say, 3.5% for 1 year and you have to pay 5% for 5 year. There's a very, very, very big difference in your repayment amount from day one. Now, instead of timing the market or trying to figure out what's going to be cheaper or trying to predicting what's going to happen, interest rate averaging is your safer way to make sure you're not exposed to massive swings if rates go up or down. Now, how annoyed would you be in 3 years' time if interest rates are still 3.5%? You could lock in 3.5%, but you had fixed for 5 years. You'd be annoyed that you've been paying 1.5% more than you could have for all that time. In the same flip side, say they're 3.5% now and they end up being 3% in 12 months' time. You're going to be quite annoyed if you miss out on that. So interest rate averaging is when you let's say you've got a $600,000 loan. You might put $200,000 on 1 year, $200,000 on 2 year, $200,000 on 3 year, and have your loan terms for your portions coming up each year. And then you've got the ability to do lump sums. You've got the ability to adjust repayments. You're not exposed to those big swings. So talk to your mortgage advisors, bankers about revolving credits, about offsets, about interest rate averaging, and don't try and time the market. You'll read an economist's newsletter saying fixed for 5 years, rates are going up, and then the next week that same economist will be saying split for some for 2 years, some for 3 years, and they'll be saying sorry, I got it wrong, or things changed. Don't get sucked in by what's going on that week. Don't let that draw you away from the main principle of not trying to time the market and to focus on the bigger things that you can control, which is your repayment, controlling your repayment amounts, and focus on buying the right property and earning more money, and focus on having the correct structures. Try not to time the market, because what I've seen is a lot of people have fixed for 5 years. Over the last 6 years that I've been talking to people about mortgages, most people that have fixed for 5 years have come to regret it during that 5 year term, because change of circumstances, income, health, maybe divorce, selling the property. There's all these things that can come up, and what often happens is a big break fee is created, and it's generally something you can avoid. So interest rate averaging and borrowing power calculations, mortgage advisor is definitely going to help you understand and guide you through the process. So if you've got any questions, comments and questions below, and please subscribe. Cheers.